indicator, and the most important will be Fibonacci. So why does this work? I think there's plenty of debate, and we can debate probably the whole afternoon about this, but I'm just going to mention what I think quickly. It's a statistical law of nature. You see these ratios everywhere, and you see them in the price behavior. So it's due to the collective mass of emotions from all the participants in the market. You get greed and fear, and out of this, they make buy and sell decisions, and you start to see these patterns develop, same as you see in nature. And then another one, I think there's a little bit of a self-fulfilling prophecy. There's a lot of Fibonacci um, teachers out there. Um, I think I was privileged, to, as I said, to discover the godfather of Fibonacci, which is Joe. So let's go on to Fibonacci. So to use this, as I said, there's going to be plenty of work. You need to memorize all this Fibonacci numbers. And nah, just kidding. So not necessary to do that. Let's move on. Okay, let's look at our tools. We'll be using a lot of tools, but these are not the tools that we'll be looking at. So you can already see Joe has taken from all the stuff out there, and he has simplified it in a way that it's usable. So this brings us to the ratios. So as I said, a lot of work. These are the ratios we need to look at. Nah, just kidding once again. So for the ratios, we'll be looking at basically only the 0.382 and the 0.618. Now, I'm not saying these other ones doesn't work. I'm just saying usually by combining these two in the way that we do, you usually get support and resistance where some of these might fall as well. And then for the expansions, we'll be looking at the 0.618, the 100, and the 161.8% expansion. So here's what we use on the leading indicator side. We use 2 retracement ratios and 3 expansion ratios, and it's as simple as that. So how do you draw this? Let me quickly demonstrate. It's very important, if you look at the bar chart, to be drawing your Fibonacci retracement from the exact high to the exact low. So you need to imagine a line chart running from the high down to the low, or from the low down to the high, and that's where you draw your retracement series from. So the line chart just gives you clarity in this case, and then you can see you take this AB move and you multiply it by a 0.382 to get a 0.382 retracement back and a 0.618. At these nodes, there will most likely be some kind of resistance. The markets could pause there, but that's not what we use. Yes, we use these, but we use DiNapoli levels. So I'll explain that in a while. So first things first, you need to know how a 0.382 and a 0.618 is calculated. And if you don't understand this, at the end of this webinar, as we said, there's a special. We've included the book, which is a great book to have in your arsenal to know how Fibonacci works. So looking at our expansions, you've got an AB move, and this is how you calculate the 0.618, the 100, 1.618. We call it the COP, OP, and XOP for contracted objective point, and expanded objective point. So taking the AB move down and plotting the total value down from point C, that gives us the 100% projection or expansion, which is the OP. Taking 0.618 of this AB move and plotting it from point C will give us the COP, which is the 0.618 expansion, and then taking the AB and multiplying it by 1.618 give us this big line. Project that down from point C, and that will give you the XOP. At these levels, you could expect the market to at least pause or get some kind of support. Same for the resistance, so it goes both ways to calculate support and resistance. So let's look at a DiNapoli level. Here we've got a more complex type of market move. So we've got a move up, but we've got an type of 1-2 leg up in this A-B move. So what we do is we draw in a focus. A focus is where the market's currently at, where it's made the most recent turning point, if you want to put it like that, and we number the reactions. So we've got 2 reactions over here, and then we calculate the 0.618, which we call the F5 as well, and the 0.382, which we call the F3, from this leg, from the focus all the way down to 0.2. And we do the same from 0.1. So you get the F5 and the F3, and then something happens. Once you get the F5 and the F3 in close vicinity. Now, how close is a matter of objectivity, and you learn which confluences are better. Different reaction points also forms different strength nodes or DiNapoli levels. But for now, a confluence zone, that's the DiNapoli level. That's where you want to act. So that gives you a good idea of where a strong support in the market will be. And we call that confluence. So 2 reactions and a confluence zone. So let's look at that. But before that, just quickly, these lines, we call that lineage markings, and they help us to see how the reaction point looks where this node or these F3 and F5 support nodes are coming from. So if you see the reaction point and you see a big strong move up, then you know most likely F3 and the F5 of this big move up is going to be strong. If it was just a sideways to upward movement type rally, then the F3 and the F5 will be weaker. So these lineage markings help us to identify stronger nodes and help us to identify the better support and resistance. So let's look at a real market example. As I said, I like the gold market. My first trade was in a gold mining share. I'll talk about that a little bit later, but you can see we've got a focus, reaction 1 and reaction 2. Now remember, when we made this high in, when was that? 2011, around 1900, we knew there's going to be support around this area. The DiNapoli leading indicators told us that. So what happened when the market came down there? So in 2013, the market came down into this zone. Gold made a bounce of $200, $250. It bounced again from the nodes, consolidated until eventually breaking and finding resistance in this area. So it gave us more than 2 years of consolidation. So even though the trends and everything was down, we knew about this big support zone, and we knew, well, gold's not really going to go down a lot until we get through this support zone and through it substantially. Now, something happened over here, and I'll discuss that in a while as well. But for the sake of this discussion, let's go back and say, well, we've got a focus and 2 reaction points and a confluence, and we knew ahead of time, back in 2011 or 12, I can't remember, that there's going to be support in this zone. So obviously things can get more complex. You get a multiple reaction move, and you can have 4 or 5, and this is where the tools will help you a lot. So same as with the 2 reaction points, we take the distance from the focus down to each reaction point, and we calculate the F3s and F5s from each reaction point up to the focus, and then we'll see where we get support. So in this example, we've got one confluence and another confluence, so 2 support areas. So if you were trading this rally and all the context was good, you'd be looking to buy this area and, let's say, place your stop below the lower one. Now that's just a basic example. I don't say that that's what we do the whole time, but this is one of the tactics that you can use. Another way that we look at this, so there we've got a focus with 2 reaction points and a confluence zone, and then we've got an ABC move. So remember, we talked about the COP, OP and XOP expansions from this AB leg down from the point C. Now you've got an interesting situation. You get a point where the OP falls together with the F3, and that's what we call agreement. And that's another DiNapoli level, which is a very strong support, and this one is a super strong support because we've got the XOP together with confluence. So that's that's definitely levels you would be interested in buying, at least for a small bounce. So let's go on to some real market examples. That's basically the long and short of the leading indicators. I'm going to look at one or two real market examples just to explain it a little bit more, and then we'll try and tie this trade plan together. So you remember this chart of the ABC with our COP, OP, and XOP. Now, when Joe was in South Africa in 2002, he gave the presentation on gold, and that's where this old colleague of mine bought the book. And in that presentation, he mentioned that gold looks set up to rally, and if it rallies, there's three objective points that it can reach. The COP at 7, let's call it 730, the OP just below 1025, and the XOP just above 1500. Now, at that stage, we South Africans were quite surprised, since we look at the gold price a lot, and for someone to call gold to these levels and tell us ahead of time, remember that was back in 2002, he was telling us if gold gets up to this level, this is going to be resistance. I'm like, okay, that's interesting, we'll keep an eye on that. So what happened was, we all know what gold did, but let me just mention something else. So in 2010, Joe did an interview on the moneyshow.com website, and you can view this website on the page where you can purchase this special package at the end of the presentation. So even if you don't purchase the package, I recommend listening to this, because in this he predicts a blowout through 1504, 1500, the XOP. So what happened was, once people start to notice that these expansions work. Now remember, in 2002 we had the COP, OP, and XOP. Now when I was in Bangkok for, I think, my first standard seminar, it was somewhere around these levels, and gold just got up to 730, made that big pullback, and Joe said, well, that's exactly what he expected from this COP. And I started to take notice of this, and remember, I was starting to get into this Dinapli trading big time, and by the time gold got to 1025, I was all over this trade. I was long in this rally, and I got out there, and gold made a drop of almost $300 plus. Now over here it also made a 200 plus drop. Remember, we knew about these resistance areas back in 1999. The XOP was a different story. Now when traders, or these levels were starting to get widely advertised, and markets tend to not give traders what they want, and that's how Joe predicted this blowout. So we had a nice retracement from 730, a brilliant retracement from 1025, and a little pause and a blowout through the 1500 before pulling back. And then some of you might ask, okay, so why can't I just use the standard tool and not the, why do I need the Dinapli tool? Well, for one, look at this chart. I mean, this is the classic tool. You can take out the lines if you want to, but these are lines from the focus up to the different reaction numbers, and to me it's difficult to spot confluence in this one. Now compare it to this chart. That's how it looks with our Dinapli tools. So it gives you clarity. You don't have all these lines. You can see exactly from which point the F3 and F5 resistance areas are calculated. You can quickly identify confluence around 1160, and also it's very effective. If you go into the lower time frames, and I trade the 5 and even the 1 minute, if the market makes a new low from here, in that previous chart you had to draw all, or take all these retracements and drag them down to the new low to get your correct levels. This tool automatically updates into the new low, and automatically, as the market moves down, refreshes these levels, recalculates the levels. It keeps them at the right of the current price, so that you can see what's happening in the market. So that's why you want to use the retracement tool, and that's why I use it each and every day.